Hey, welcome to the Guaranteed Retirement Guy Show. My name is John Stevenson, and today we're going to be talking about income riders and the best ones for flexibility and liquidity. So with income riders, you do have a lot of flexibility, and you do have most of it is liquid, at least during the surrender charge period. And then after that, it's completely liquid. So they're very flexible. People like them because they can have usually the highest annual income for life, and they can activate it whenever they want to. And if they decide to cancel, they can take their money out as well. Now with a SPIA or a DIA or a QLAC, you cannot do that. They don't have cash value. Once you put the money in, they're irrevocable. You cannot change anything about them. Okay, so a lot of times people will shy away from this because they want to have a little bit more control over their assets. So I'm going to show you on my screen the best ones that you can set up for yourself, and I'm going to show you how the liquidity works and also the flexibility on turning on income. Okay. All right. So if you look at my screen, you will see someone in Ohio. They're 62. Their spouse is 60. I'm doing a joint payout, and they're putting in $500,000. And they are not going to take income for 5 years. Okay. And so it's going to be a level payout. So there are increasing income payouts that you can do, but they're going to give you initially a smaller amount at the beginning. And a lot of people don't like that, and they'll just use multiple contracts to provide more income as they age. That's usually the best way. That's usually what I recommend. That's what I'm doing. So, but let me show you exactly what this will do for you as far as liquidity and flexibility. Okay, so $500,000. If we look at the income, it's $50,780 after 5 years. And that's guaranteed for the rest of your life and your spouse's life. That's pretty good. Okay, so we look at this and let's see where the liquidity stands. So I'm going to show you worst case and best case scenario. Worst case is there is no growth in the index because with an income rider, it's attached to a fixed index annuity. That indexed annuity is earning interest based off of an underlying index. And that is only earned if that index does well because the insurance company is buying call options associated with that index, and they're not going to exercise those call options unless they actually have a rise in the index. So that's how you earn. But let's say there is no growth. And for this example, it's the S&P 500, which is probably very not likely. But if you're looking at zero growth over those years, the worst case is your account value is going to go down by the time you're 75. The income's there, that's guaranteed. And of course, if you die, the death benefit's there, that money's there, and there is a cash surrender value. Now, let's talk about liquidity because cash surrender values are less than the actual account value. Okay, so if we look at the cash surrender value, you can see $471,000 versus $489,000. That's if you decide to cancel the contract. There are surrender charges. So these do go down though over time. So if I go down over here, you will see here's the surrender charge schedule right here. So it's for 10 years, starts at 9% and goes gradually down till it hits zero after the 10th year. So that's how it works. So obviously the longer you keep it, the lower your surrender charges will be and the higher your liquidity will be. Now, the other thing you have to remember though, is if you're taking this for income, who cares? Okay. You're not going to ever liquidate this. You're never going to cancel it. And you're just going to take your income and let it liquidate itself. So you're doing it for lifetime income. And if you do that, it's going to give you like $1.5 million. That's really good. So that is really, these are pretty liquid. You just have to remember that they do have surrender charges in the early years if you don't keep the contract, if you cancel it, or if you take out more than the 10% free withdrawal allowed that most of these will allow you to do. If you do decide to take out 10% each year without any penalty, you can do that, but it's going to reduce the amount of lifetime income you're going to get later on. So just remember that. So it's flexible in that way. You can do that. You can take some money out if you really need it, but usually it's a good idea when you buy an annuity contract to have money outside of it, lots and lots of savings outside of it so that when you do have emergencies, you can tap those instead of touching your annuity contract, right? That makes sense. So now we want to look at flexibility. Okay, so I'm going to go back here and we're going to see here at 5 years, it's $50,000, but let's say, you know what? I'm 67. I'm going to work 3 more years. I'm going to work till I'm 70. I'm going to maximize my Social Security payout, and I want a little bit more income from this annuity. So I'm going to defer it a little bit longer. It's really nice because you can take it whenever you want. Okay, it's very flexible. So if we look at this and say, all right, well, if I wait, how many years is that? 8 years. It's $66,467. Wow, that's great. And it's just because you let it grow longer. Okay, with an income rider, you're not when you submit an application for that, a lot of people ask me, do I have to tell them when I'm going to take income? Because I don't really know. And I'm like, no, you don't. You're just setting yourself up for success, for higher income, and you decide when you take income, okay? And that's really comforting. And if you decide to take income earlier, they show you exactly what it's going to be. You can see right here. So if you take it earlier, like if you take it in 12 months from now, it's 35 grand. If you take it in 24, it's 39. If you take it in 36, it's 42, and so on. So every year, you see the benefit base, that grows, the withdrawal rate grows. So every anniversary of your contract, you've got the roll-up rate and the withdrawal rate that rises guaranteed. And so you look at that and say, well, that's pretty good. If I take it after 5 years, it's 50 grand. Okay, that's what we were looking at before. But if I decide to wait another year, it's 55 or 60 or 66 if you wait till 70. So it's pretty nice. And it's just because you're allowing this benefit base to grow. Let me look at the growth rate here. They're giving you an 8% compounded roll-up rate for up to 12 years. That's really good. And an 8% benefit base bonus right from the beginning. So that's what makes this work so well. So when you look at this, you have the benefit base growing to almost $1 million guaranteed during 8 years. And then if you activate income at that time, it's 999,502 multiplied by 6.65, giving you that $66,467 for the rest of your life and your spouse's life. Now, if you got a different age, your spouse different age, this will fluctuate a little bit. If it's a single payout, it's going to be higher because the insurance company is on the hook for less lives, right? They're looking for just insuring one person instead of two. So it's definitely lower risk for them. Now, if you're wanting to figure out how this would work for you, go to my website, johnstevenson.com. You will see all of my annuity calculators. You can figure this out yourself. You can plug in your own numbers. It'll give you all of the payouts for you individually or as a couple. And if you want to book a call with me and you're thinking about purchasing an annuity, you can do so there as well. Otherwise, there is a link right below this video that allows you to do that as well. So anyways, I just want to be very transparent on these things. When you're looking at annuities, make sure you're looking at all the options. Okay. This is why it's so valuable. When you go to my site, you will see there are hundreds of options. Okay. Because a lot of guys will just try to sell you, 2 or 3 options. And a lot of times they pay them the most commission. It doesn't pay you the most income. And it's just a conflict of interest. And a lot of people don't know it. They're trusting their advisor. And sometimes their advisor can't sell them anything else. Sometimes they're just kind of tied to whatever their broker dealer tells them to sell, which is unfortunate when you're trying to do what's best for your client. So I'm a broker and I deal with all the companies. And so I offer everything. And so that's why I am an annuity expert. And that's why people reach out to me, particularly for lifetime income. And if you're looking for that, I'd love to help you. So anyways, hope you like the video. Make sure you like, subscribe, share. If there is a comment below. Okay. I'd be happy to answer that. Be happy to help you any way I can. So thanks again. And we'll see you next time.